After quite some time being a quote-unquote dividend investor, I have certainly made mistakes. Plenty of them. And being in the position that I'm now in today, here on YouTube with you every single week, I actually realized that I wasn't alone in making a lot of these mistakes. No, many of you are actually, for the same reasons I was making them, are following suit. However, these days, I am now just in the position to watch many of you make these mistakes and really just shake my head. Also, it fuels me to continue to make videos like this in hopes to get the word out to all of you and really warn fellow dividend investors before they actually leave money on the table. Which actually brings into question what Buffett was always talking about, his rules to investing. The first being don't lose money, and then the second being just don't lose rule number one there. Now, whether it was chasing dividend yield, buying without any real rhyme or reason, or rationale, or worse, just selling for steep losses only to then watch the stock soar like a SpaceX rocket afterwards, none of those rookie mistakes are what I'm actually about to talk about right now, right here with you. So then this begs the question, what is every single dividend investor actually struggling with? Well, if I really had to put my finger on it, whether us dividend investors are at the very beginning of our financial freedom journey or nearing the final destination, which don't worry is just the retirement pasture, we all tend to overlook one uncomfortable, glaring truth. An exchange-traded fund can just do it better than us. Now, before you click away, hear me out. I know more than anyone just how fun investing can be. I mean, the allure of digging for diamonds in the rough of the market, the fact that finding the bottom line of a balance sheet and then actually understanding that balance sheet and seeing if this company can be profitable or will be profitable in the near future given the rate of revenue generation, or just the plain old ego boosting clout worth of telling everyone you know from your mom to your dog that you received 77 dividend paychecks in 1 month. Oh yeah, there's nothing quite like it. Except there is. And a matter of fact, I'd say there's something better than that, just stroking your ego, which is actually realizing that investing is all about, literally only about, total return. That doesn't mean you need to do away with your dividend investing strategy entirely, but it means you have to understand, as I always say, your investor profile, and then go ahead and invest accordingly to smash your financial goals, which ultimately all wrap around total return and having that strategy in mind. This will require you to be honest with yourself as an investor, something a lot of us have trouble with. Now, what exactly is total return? Well, I'm happy that you didn't even ask, but it all comes down to your performance, reflecting the actual rate of return of an investment or a pool of investments over a given evaluation period. This is inclusive of dividend income as well as sheer share price appreciation. Any good investor, like, I don't know, take Warren Buffett again for an example, well, he would tell you that you'd be a clown to invest into stocks solely based off of their dividends and the dividend income you'd receive. And a matter of fact, Buffett himself was only focused on high quality businesses that would really be around through the thick and thin of the market highs and lows, regardless of dividend distributions. But either way, you really have to start to think about total return, because if you're on the younger side here and loading up on high yield dividend stocks, well, congratulations, you just sold your future self short. Moreover, I have news for most of you. If you're in your 30s, your 40s, or heck, even your 50s, you certainly have time on your hands before you should be myopically focusing on dividend yield or just investing solely into dividend stocks. But what does any of this really have to do with exchange traded funds? These baskets of stocks that allow us investors to invest really without a lot of stress or any stress at all, and knowing that a broad market fund allows us to win whether the market is down or even on the up and up, well, everything, because most of Wall Street's finest actually fail to beat the S&P itself. And more than that, the ultimate kicker, most mutual funds out there and even ETFs fail to beat the S&P as well. So this is what I'm going to share with you right now. Stop doing everything that you're currently doing when it comes to investing. Go to whatever investment return calculator you can possibly find out there and start plugging away on how much you would have returned if you simply just invested into an exchange traded fund, one that pays dividends or not, or the S&P itself. Doesn't really matter. At the end of the day, you just may find that you have not only been investing at a subpar level, like most of Wall Street's finest, based on the gambler's mentality of thinking that you can win, or worse, you might have left money on the table and have been doing so this whole time. Just to really highlight the power or of keeping it simple, we could just take Vanguard's VOO, which is just their S&P 500 ETF that covers 500 of America's best and most dominant companies, and simply invested $10,000 into this baby 10 years ago without even touching it, you would have experienced an average annual return rate of about 13.06%, which works out to an extra $24,136.08, which is a hefty sum, again, just considering most of Wall Street, and therefore I'd argue probably most of you are underperforming that amount. But now, more importantly, work the math on your own portfolio and compare the performance returns. Did you perform? Outperform? Whereabout were you? And be sure to follow up those questions with even more questions, like, were the returns that you brought home really worth the stress? Could your time have been better spent elsewhere instead of pouring it all into the research, which maybe some of you didn't even do in the first place like you should have? Or finally, looking into the future, at the current rates of performance of both your portfolio and the S&P, who will ultimately end up with a better total return sum? The investor that you are now, or the investor that's a little bit wiser, invested into an ETF or the S&P for maximum returns, while also winning his or her time back to invest that elsewhere? Now, investors, you let me know your thoughts down there in the comments. I want to also know your strategy. Are you outperforming the S&P? Or do you really think that all of this is even worth it? Should us investors be focused on dividend stocks and individual stocks, or just focused on the S&P? With that, I want to go ahead and gift you with this Masters of the Market chat right here. A bit different of a perspective, but we have a dividend millionaire talking all about his journey on how he actually made the dividend wealth himself by investing into dividend stocks alone. With that, subscribe to the channel, and I'll catch you all in the next one.